Do you feel like you're missing a secret ingredient when it comes to investing in stocks that everyone else seems to have? Maybe you're new to the stock market and you're overwhelmed at how many stocks are out there, which ones to buy, and how to decide if a stock is really going to pan out the way you want it to. Well, I've got a 6-point checklist on how to find financially healthy companies with plenty of growth and plenty of upside potential over the long term that I can't wait to talk about and show you. So let's get into it. Okay, so number one, the company has to have been traded on a major exchange for 5 or more years. This is an easy one to see, but the main point for this is we want to be able to see a solid foundation of information at our fingertips that we can sort through, and so we can make great decisions on where the company's been and where the company is going. So I'm going to pull up macrotrends.net here. So if you're just logging on to this page for the first time, let me do that. All right, this is your homepage for macrotrends.net. We're going to come down to stock research, and we're going to go up here to search. Let's do Apple. All right, we'll click here, and it brings us to our page here, and let's just go over to prices. Disregard the ads. And we can scroll down, and as this graph loads, we can look back and it'll give us dates, and this is just the price chart. And obviously this goes way back all the way to the 80s, early 80s. So this is an easy way to look. You can look at your trading platform, whether it be Robinhood or Charles Schwab or Webull or whatever you use to invest. You can look at the chart and you can see how far it goes back. We want at least 5 years though. Moving into point number 2, we're looking for profitability. We want positive net income for the last 4 quarters or more and increasing net income over time. Net income is let's use an easy analogy. Let's think about if you were a kid selling lemonade in your parents' driveway. So net income is the money you're going to have left over after you pay for the ingredients of the lemonade, after you pay for the stand, what it took to build the stand, the supplies. If your parents charged you rent to use the driveway to sell your lemonade, after you've paid them, and after you've paid your employees for selling lemonade. Whatever you end the day with after everyone is paid is your net income, including taxes. Number 3, we're looking for positive growth. We want to see a company that has steady revenue growth over time. Going back to the lemonade stand, revenue is just the money coming through the front door. This is the money that your customer pays you for the lemonade. This is just a really basic metric of the money coming through the front door, and we want to see that increasing over time. Increasing revenue growth is how a company continues to grow. Let's pull this up here, and for Meta, revenue profit at the top. Coming down to the next line, we click on revenue. And yeah, this is exactly what we want to see. We want to see this moving up and to the right, and this is great revenue growth. And even if we were looking at it and we were at this period here where we had kind of a dip, that's still great revenue growth. And a lot of times when you're buying a stock, you're buying it in these little dip areas. That's usually where all these things, price starts to dip with. If the revenue growth dips, all these things kind of work together, and that's usually where you're getting a good deal some of the time. Part 4, good balance sheet. This has a couple areas we like to look at. Think of a balance sheet as the company's financial health and them balancing their checkbook. We want to see a company that's got a lot more cash in the bank, assets. We want to see if there's debt, which most companies use debt to their advantage. We want to see a good ratio of that debt, this is really where we see the financial health of a company, and we want to see good financial health. Do they have cash on hand that can save them if things get rough? That's what we want to see here. So the first thing we look at is the company has increasing cash on hand over time. We want to see the cash they have in the bank increasing over the long term. It's okay if they use it sometimes to buy up other companies or to buy more shares, to do share buybacks. These are all good uses of cash as long as for the long term, they're steadily racking up cash. The second thing we want to see is the company has at least 50% more total assets to total liabilities. I like to see 50% or more. I really like to see double. I really like to see double the total assets, total liabilities, but this is where sometimes I can give some leniency. If you get to this point and your company you're looking at has all these things, add it to your watch list, because this shows a good company. Now, it doesn't mean it's necessarily a buy, but if you have all four of these things lined up for you, this is a good point to add it to your watch list. So let's look at some examples of looking at a balance sheet here. So we're looking at Meta. Let's come over here to financials on the top line, and we're going to come down to balance sheet. And the first thing we want to look at when analyzing the balance sheet is we want to see the cash on hand increasing over time. So we're going to click on cash on hand, and here we go. On a quarterly basis, we see a growing free cash flow here, and we're at all-time highs for the amount of cash they have on the books. That looks great. Love to see it. Let's come on back. We're going to go back to financials, back to balance sheet, and now we want to see total assets versus total liabilities. I like to see at least 50% more total assets, total liabilities, double if possible, and boom, we're looking at a great balance sheet here. I mean, this is over somewhere around over three times the total assets, total liabilities. Meta has a fantastic balance sheet. So this is definitely a stock to put on your watch list, in my opinion. I'm not a financial advisor. Take everything I have with a grain of salt, but I have it on my watch list. I think Meta is a great company. All right, so the last thing on the list is we want to make sure that this company that we found that's a great company, we want to make sure the price is right, okay? This is so important. Just because the company is a great company, just because they're extremely profitable, growing margins, growing cash on hand, doesn't mean the price of that company is right to buy. It could be very overvalued. It could be like paying $50 for a Hershey's bar. You just wouldn't do that. So this is really where the rubber hits the road when you're looking to buy a stock. You want to make sure that that stock is a good value and that you've got plenty of upside potential. And this is what gets a lot of new investors, because they see a stock going up, everyone's talking about it, and then they're buying at all-time highs, the valuations through the roof, and over the next year, that stock just drops and drops and drops. You want to be buying it when it's low at the drop, but just because the price drops doesn't necessarily mean that it's still at a good valuation. So a couple things we want to look at is we're going to use the PE ratio here, and it's a multiple. The PE ratio is the stock price divided by earnings per share. Now, if the company's not profitable, you're going to see a 0 for PE ratio, and that's why it's important that you use all these checkpoints together, because if you don't have a profitable company, you won't be able to really base this on a PE ratio, because the PE ratio will just be sitting at 0. So we want to see a PE ratio under 50, and we want to see a PE ratio that's lower than average, preferably in the last 10 years, for the company, coinciding with a dip in share price. Now, not every stock is created equal. A lot of people will tell you a 50 PE ratio is high. And for some companies, it definitely is. I mean, there are companies out there that 50 PE ratio I would never buy, but there are others that when the PE ratio dips down to 50, it might be a buy in my opinion. And this really coincides with the growth rate of the company. A company like Tesla is still in high growth phase of their tenure. A company like Hershey's has been around for over 100 years. they're not going to be trading at a 50 PE ratio. They're going to be trading a lot lower. So this is really why it comes down to looking at that specific company and their recent history on where they might be a good value. So let's pull up some examples here. This one's going to be the one that takes the most practice. So Meta, let's look at price ratios, and we're going to come down here. It automatically puts us right on PE ratio, and let's scroll down and look at this. So up here we can see the stock price. We can see the stock price is at all-time highs. So that kind of negates part two, that we want to see a dip in share price, but that's okay. Let's look at it. And down here, we see what looks pretty low, but these aren't low. We had this at the beginning of end of 2012, beginning of 2013. This PE ratio was sky high, and it kind of took some time to level out. So we can move this bar over, and we're going to move it right here before 2014. So this is pretty much the last 10 years. And you can see that we came down from those really high levels, and we came all the way down here to a dip around just over 17, and then it went up to 32, and then it kind of dipped down here. Now 2022 was a market crash, so we got all the way down below 15 here. We got all the way down, below 13 right there. We're at 14, and then it came up to above 30 and kind of leveled out here in the 20s. So me looking at this, we had a low point here. It's just over 17, and it got down all the way below 13 here. You could start getting a little liberal here, and maybe you might decide, hey, under 20 is where I'm willing to buy Meta. Or there might be a crash, and there might be low P ratios hitting all over the stock market. So if there's a lot of good deals out there and you're looking at Meta, you might be like, look, everything's dropping. I want to see this thing below 13. I want to see this thing that's the low it's ever been when I start buying. So it just really depends on your level there. Now, if it's above, looking at this, if it's above 30, that's starting to get a little expensive. For me personally, I'd be looking for under 20. Like right now, I'd be looking for under 20 for Meta. But I'd also understand that it might keep dropping. If we see a market crash in the next year, 2 years, which could happen, I'd expect this thing to drop down here under 15, and I'd be buying more as long as the rest of the company's fundamentals are looking good. So let's look at another one. Let's do a couple examples of the PE ratio. Let's look at NVIDIA. NVIDIA's been a powerhouse. Let's see. Something like NVIDIA, you're kind of expecting something high because it's been on a roller coaster for the past couple of years. It's experienced a ton of growth. Like again, we're going to P ratios, and then P ratio is the first one that pops up here. So let's scroll on down. Look at that stock price. We're back here in 2009 and 27 cents a share, and it's we're at 137. Explosive exponential growth for NVIDIA over the past couple years. Really the last year and a half. So if we go all the way back to 2010, we're looking at, we had some zeros here. This is where they had a few quarters that were unprofitable. And then we've just seen this growth going on. And we've seen some heights. We got up to 50 here. We dipped down to 21. And then we got a height here, pushing 80. And then it dipped down to 49. It got all the way at its height to 144, and now we're kind of leveled out around 50. Now this is one that takes some experience. So if we pull this to the last 10 years, let's get right at 2014. We see the lowest rate in the last 10 years. We're seeing right there around below 20, almost to the 15 range, but really below 20. This was right at 21. So You could say that you want to see this thing below 20 now with the explosive growth it's had in the last year. It's kind of catapulted it into a new arena. So this is where some experience catches up with you, and you might say, I want to see this thing. Right now we're around, 50. I want to see it, in the past 4 years, it's stayed above 50. I definitely want to see it under 50 for sure. And you might say, well, if it gets down to around the 40 range, that might be where I'd want to consider buying. But, it's in the past, it's been down here under 20. So take that in consideration. That's where, you might just want to play it safe and say, you know what? It's kind of it's changed. It's a new high growth stock in the last year or so. I'm just going to kind of let this one do its thing and move on to something else. Let's look at Apple. Actually, let's look at Nike. Price ratios, PE ratio, we're there. Scroll on down. All right, so with Nike, we're looking at stock price, and we're seeing a big dip here. I mean, this thing's been coming down since the end of 2021. We had that stock crash in 2022, and it never recovered from that. Nike, I am invested in Nike. I like Nike for the long term. They've had some issues with their CEO change. Nike had a period where they were trying to sell direct to consumer that just didn't work out for them. And so they've kind of gone through a rough period. Now, this happens with companies, especially companies that have been around for decades. They go through periods where they have a tough time. They try to push themselves in a new arena. Sometimes it works out. I mean, look at NVIDIA that we just looked at. And then sometimes it doesn't. And this can be where you can find really good deals in the market. Nike's a great company that has long-term staying power. They have a good moat. So this is really what we like to see. We like to see a stock that's been beaten down for a couple of years. This is where we might find some really good value in a company. So if we come down here, this is the last 14 years or over of P ratio. We see the lowest point is back here. In 2010, we saw it get under 15. So, and then it's kind of steadily had an increase. It got all the way up to almost 30, and then it dipped back down to 20, 19. So it got back down in under 20. And, if you're looking back here, that was a good place to start buying the stock up because we had a share price of almost 60, and then it dipped down to the mid 40s. And if you were buying that dip, that coincided here, if you were looking at this history and saying, well, it got down to around 15, the high of 30, I'm going to start buying, if it gets under 20. And so you had this short period there where it was, and if you were picking up some shares there, you had a pretty quick, good return, and it kept going. Now, let's move this to the last 10 years. So when we're looking at the last 10 years, we're seeing right here in the low 20s, 20. That's the lowest thing it's been in the last 10 years. So, and here we had a dip and it was around 30, and we had some highs here. Obviously here it got up to pushing 60, right there 60, and up here all the way to over 70. So this thing was starting to get pretty high for its history in PE, and it's steadily been dropping with the share price. And now we're at, around getting close to around 20. And we look back here at the lowest we've seen in the last 10 years was just under 20. For me, this is a good place to buy. I mean, I'd almost say under 25, you might play it safe and say under like 23 or 22 or something. But, the further this thing is 20 or lower, man, I think this is a great buy. Take that with a grain of salt. Not a financial advisor. I'll say it, time and time again. Do your own research, get comfortable with this stuff and where you feel comfortable investing in it. But I think that's great, and that's really what I'm looking for here. Last 10 years, we're at historical 10-year lows here, so I think that's great. So let's do a couple of examples of going through this whole checklist. So the first thing, we're going to pull up here. Let's do Sure, let's just stay with Nike here. And let's see. We'll go back to our notepad here. And number one was the company has been traded on a major exchange for 5 or more years. So how we check that if we're on macrotrends.net is we come up here to prices, we scroll down, and this graph here is we can trace it all the way back. And yeah, I mean, we're going back. It goes all the way back into the 80s, I think. So yeah, so we're good. That's check number one. Now, number two is profitable. We want to see positive net income for the last 4 quarters or more, and we want to see that net income increasing over time. Come back up here. We're going to go to revenue and profit. We're going to come down to net income. And so for the last 4 quarters, this middle chart is quarterly. We've got profitability. If it wasn't profitable, it'd be one of these negative bars. So in the last 4 quarters, they have been profitable. And since 2010, we have seen steady growth over time. And we see a kind of a line here that goes up and to the right. So that looks good. Now we want to look at number 3 is steady revenue growth. So we're going to stay in revenue and profit, and we're going to come over here to revenue. And we want to see just like this. We see steady revenue growth over time. This is going up and to the right. You know, of course, there's going to be some dips in here. It's never going to be perfect, but in general, this looks great. So that's check number 3. Number 4 is the balance sheet. We want to see increasing cash on hand over time, and we'd like to see the company has at least 50% or more total assets, total liabilities, double if possible. So let's come over to financials. Come on. Balance sheet. All right, cash on hand. So yeah, we're increasing over time. There's some peaks and valleys here, but in the last, this goes back to 2009. So in the last 15 years or so, we have more cash on hand than we started with 15 years ago. That's good. We're going to go back to the balance sheet. Computers run a bit slow here. So let's look at total assets and total liabilities. So we've got 38 billion in total assets, and we've got 23.5 billion in total liabilities. So 50% more, half of 23 is going to be around 12. So yeah, well, this is 50% more total assets, total liabilities. So we're within that range. It's not double, but it is more than 50%. So check on that box there too. Now we're going to go to make sure the price is right. We want to start looking at PE ratios. We want to see a PE ratio under 50, and we want to see one that is lower than average in the last 10 years for Nike. Price ratios, PE ratio. Let's take a look. And we were just looking at this earlier. I think this is a slam dunk of an era to buy Nike stock. That's just me. You want to make sure you do your own research and decide if it's a buy for you. But according to our checklist, Nike looks good. It's looking good. So let's look at another example. Let's do something fun. Let's go with GameStop. Not as popular right now as it was, but it's had some crazy times. Okay, number 1. The company's been traded on a major platform for 5 or more years. We're going to come here to prices. And yes, we go all the way back to 2002. Now, part 2 is profitability. We want to see positive net income for the last 4 quarters or more and increasing net income over time. Revenue profit, We're going to come down here to net income. And all right, quarterly. We've got profitable, profitable, not profitable, profitable. So that doesn't hit our checklist. Also, from here, we're starting off to top and to the left, and we're kind of moving down and to the right. So this also, for increasing net income over time, this is actually more weighted to going to the right and down. So that doesn't check the box either. So let's keep going though. Steady revenue growth. So let's come back up. Revenue, profit, revenue. Ouch. So since 2010, we have seen the opposite. We have seen decreasing revenue growth, and that is over 15 years. That's not looking good either. All right. So that box is not checked either. Let's check out the balance sheet. Number 4, we want to see increasing cash on hand over time and at least 50% or more total assets to total liabilities. Okay. Financials, balance sheet. Let's check out the cash on hand. All right, so this one does check the box. We see increasing cash flow over time. We've seen explosive cash on hand. Now, this is going to come from the massive increase in share price, most likely, of the people buying the stock. So, hey, that's a check on the box. So let's go back to the balance sheet. And let's see if we've got 50% or more total assets to total liabilities. So we do have more total assets. We got 2.7 billion to just under 1.4 billion. So 50%, it's pretty close. Let's see, that's going to be 150, so 650. Yeah, so we're 50% or more. So balance sheet on GameStop doesn't look too bad. It looks like they've been doing a good job with the balance sheet with the new uptick in investors over the past couple years. So balance sheet checks the boxes for GameStop. Number 5 is the price has got to be right. This one for me is the most important thing on the list. P ratio, I want to see it under 50, and I want to see it in a lower than average place for the last 10 years, and I want to see a drop in the share price. So price ratios, PE ratio, we're there. Here we are. Here's the stock price. I mean, we are kind of in a dip. We're recovering from a dip here. And however, the PE ratio is 178. So that is pretty dang high. That is way above 50. I don't feel comfortable touching that. And then it's pretty inconsistent PE ratio here. Obviously, we did not have profitable quarters, so we're just at kind of a 0, and it pops up to, when we do have some profitability there, it pops up to 43. We're down there. And then before 2018, we were in the well under 10 range for most of the time. We saw a jump there to 11. And going back all the way, even back 15 years ago, we stayed under 10. So this is well above 50. I'm not touching it. This is not anywhere close to where it has been, over 2 years ago. So this one is anything but a buy for me. I would not feel comfortable holding GameStop, but that's me. Some of the people that buy it, it's more of a risk to reward thing. For me, that's kind of a gamble. I'm not into it. So let's do one more example here. I know this is a good one. This is something I've just started building a position in. Adobe. So number 1, the first thing we want to see is a company that is established and known and has been on a major exchange for 5 or more years. So we're coming here to prices. And yeah, We're going all the way back to the 80s with Adobe. So that checks that box. Number 2 is profitability. We want to see positive net income for the last 4 quarters or more and increasing net income over time. So come up here to revenue and profit. And we're going to come down here to net income. Scroll on down. And the last 4 quarters have been profitable. And we see nothing but profitability on this graph. Actually, right there, the first quarter on the list was negative. But yes, we see over the trailing 12 months graph, we see a positive growth long term in the last 15 years for net income. So that checks that box. So number 3 is positive growth. We want to see steady revenue growth over time. Revenue profit. We're going to come over here to the left, revenue. And yeah, we got great revenue growth going back to 2009. This is just, especially in the last 8, 9 years, 10 years, we've seen fantastic steady growth here. So that looks great. That checks that box. Let's check out the balance sheet. We want to see increasing cash on hand over time, and we want to see 50% or more total assets, total liabilities. Preferably double if we can get it, but we'll take 50%. So financials, balance sheet, and we want to click on cash on hand. And yeah, there we go. We've got increasing over time cash on hand. The quarter before this past quarter was at all-time highs for cash on the books. So we're looking to be in great shape there. So part 2 of number 4, let's go back to financials. Balance sheet. And we've got almost 30 billion in total assets, and total liabilities is just over 13. So yeah, we're at over double total assets to total liabilities. Fantastic. Great balance sheet. So number 4 is checked. Now, the last one, of course, is the price has got to be right. We want to see a PE ratio under 50, and we want to see a lower than average for the past 10 years PE ratio for Adobe right now. And we want to see a dip in the share price to coincide with this. So we're going to come up here at the top, price ratios and PE ratio. And here is the stock price. We've seen kind of a running sideways period, but we are in a dip phase here. And our PE ratio right now at the top, it says 29.93. So we're under 30 right now. Historically, we've seen a PE ratio get all the way down to below 15, but preferably in the last 10 years, if we see a height here of 150, over 150, it dips down, we see 44, we see a top here of 65, it dips down to 40, we see another above 65, we get a dip down to just over 30, up here around 50, above 50. So if we're looking in the last 10 years, our dips are showing us, we kind of had a dip here at 44. We had a dip here of 40. We had a dip here of 32. So for the last 10 years, I'm kind of feeling like if we can get something, under 35, that feels like a pretty good buy, and definitely under 30. If we get some, in the last 10 years, the lowest we've seen has been about 32. So if we can get under 30 here, that's great. And that's where we are. We're just hit under 30. That's why I just started a position in Adobe. I like it. I'd probably be, depending on the dip, be willing to buy anything under like a 33. So if it stays under 33, I will steadily be buying shares of it. Adobe looks fantastic to me. It's got a great platform. Obviously, once you get to this phase and you find a stock that checks all the boxes, you want to look at everything else. You want to learn as much as you can about that company. This checklist will get you 90% of the way there. You'll be 90% better than the other 90% of retail investors. You'll be in the top 10% if you check these boxes. This is a great way to start your journey as an investor. And once you find a stock, this is where you want to move into listening to conference calls, and you want to be reading 10Ks, and you really want to be soaking up as much information about the company that you found that checks all the boxes to feel confident that you are putting your money into this company for years to come to get great growth. And, you know, that's what we're looking for as investors. We want to see growth, financial health, and we want to see a good value. But you want to do your own research. You want to dig as deep as possible because you don't want to just be above average as an investor. You want to be in the top. You want to be one of the best. I mean, why would you not? If you're the better you get at this, the more money you should be able to make investing for your future, investing for your retirement, or to get to the point where you just make your living off being an investor. So guys, that kind of brings our video to an end here. I want to talk to you about, once again, study up on this stuff. This is a great starting point. Go out and watch other YouTube videos, follow other people, and see if their information coincides with the stuff I've given you today. Like, subscribe, do all that stuff. You know, I'm just a Yahoo on YouTube. Take what I have to say for a grain of salt. I'm not a financial advisor. However, this information has done great things for me and my portfolio over time, and I never stop learning. And let's build a community of people that are interested in doing the same. You'll have a great day. Like, subscribe. See you later.